Hi there, welcome to Kneppy Invest. On the morning of 19th of February 2025, one of the biggest companies on the ASX, NAB, released a trading update for the first quarter. And the share price subsequently fell over 7%. And without even looking at the update, that is suggesting the market didn't like it. The market didn't like it at all. So what I did, without even looking at anything, I went to Hot Copper just to see what the boffins there were saying about this company. And I was surprised to see quite a few posters suggesting this was a perfect time to buy NAB. And by saying that, they were probably suggesting again that this company was undervalued. Now, I am biased against the banks right now. I believe they are overvalued. In fact, I'd say in some cases, historically overvalued. So I want to test that hypothesis. Is NAB a buy right now with the share price dropping 7% on the back of this disappointing trading update? And I think this could be the shift in sentiment for the banks, not only NAB, but all the banks. And this could be one of the worst times to buy NAB. So I'm going to test that hypothesis just by looking at some financial metrics, historical financial metrics of this company, focusing on the P/E ratio and the price to book. Now, before we have a look at that, I'll just briefly go through this update. I didn't really have a close look at it. I just read some articles on it. Now, the one thing I didn't notice, profit was down 2%, which actually was lower than expectations. But for a company whose share price has risen 40% and whose P/E ratio was like 18, price to book 2, you don't expect profit to drop. You want to see profit rising because the P/E ratio of 18 is the sort of ratio you see for a growth company, not a quickly growing company, but definitely growth in there somewhere. And NAB is just not growing. In fact, if you have a look at this company's profit, earnings per share, dividends over the past 10 years, they've gone nowhere. In fact, they're down of that period, which is again suggesting this company is not a growth company, it's not a high quality company, not the sort of company you own for the long term, according to my own rules, my own personal rules. Okay, so profit was slightly down. There was also some other concerns here. So this is via market index. They were talking about credit quality disappointed, coming worse than expected, while the CET1 ratio also missed estimates, raising concerns about future buybacks. Net interest margins was softer than anticipated, with margins pressured by deposit trends, rising lending costs, and heightened competition. And the CEO, Andrew Irvine, mentioned that even though the economic outlook is improving, now I put in there even though because he just started that sentence with the economic outlook is improving, but, and whenever you see a bit of a positive spin and then the use of the words but or however, you know something really negative is going to follow that. But cost of living and interest rate challenges persisted during the first quarter. While most customers are proving resilient, we have maintained prudent balance sheet settings to allow us to support customers while keeping our bank safe. And funnily enough, a lot of people do put their money into the banks because they do believe it's safe. But banks are cyclical. In fact, if we have a serious downturn in the economy, if we go into a really deep recession, the bank share price will absolutely collapse. In fact, was it 1990 that Westpac was saved by the government or something? Yeah, 1990. So don't forget, banks are cyclical and they do see really negative effects when we see the economic conditions downturn a fair bit more than what we have seen. So don't forget that. Don't think the banks are safe. And I also would actually not be surprised that many shareholders in NAB are perplexed by why the share price and how the share price can be down 7% for this safe company that they probably think shouldn't have this amount of volatility. It's volatile. Down 7% is sort of thing or sort of movement you would find in a company that has share price volatility. Okay, so let's have a look at whether this company is good value with the share price dropping 7%. Now, I just mentioned earlier, this company has not experienced much growth in the last 10 years. In fact, revenue growth is negative. Well, actually, they don't show it in NAB, but I'm assuming it's negative. Earnings per share, 0.3%. So that's no growth when you take into account inflation. In fact, dividend per share growth is down, negative 1.6% over the last 10 years. So if you're just relying on income and you want that income to increase because of inflation, NAB is not one of the places you want to put your money. Anyway, so you could argue over the last 3 years, we have seen a nice little increase in dividends, earnings per share, and revenue, but it's all around about 5%, which is not that exciting growth. And I wouldn't expect much growth in NAB over the next 5 to 10 years. Okay, so what I'm going to do now is have a look at the price to earnings and price to book ratios of this company and just compare it to historical levels, because I think that's the best way to judge whether this company is good value on the premise that this company is not going to experience much growth. Now, if you do have a feeling or evidence maybe that this company can grow significantly over the next 10 years, then maybe, yeah, this company is good value, maybe. But let's have a look. So what I'm going to do now is just have a look at the price to earnings and price to book. I was getting a little bit ahead of myself by saying if this company experienced good growth, then maybe this company is good value. We can't really say that until I look at the P ratio and the price to book. Okay, so P ratio right now is around about 18. Price to book is around 2. And those, without looking at it, those seem to be quite high, even after a 7% drop in share price. Historically high. I'm going to say that, particularly the price to book, historically high. So in FinChat, all you have to do is go financials, and we can have a look at, where is it, ratios, and you'll see quite a few ratios here. Just take your time, FinChat, no need to rush. And what I'm looking for here is price to earnings. Now with FinChat, I am a subscriber. I have 10 years of history. Actually, it's 10 periods of history for some reason, not years. Guru Focus is 10 years, no matter if you're looking at half years or full years. For some reason, FinChat, if you're looking at half years, it's only 5 years of half years, which is really, really weird. Okay, so what I like to do is just have a look at the P ratio of a company, historical levels. And if you have a good understanding of a company and potential growth even, you can sort of judge whether a company might be undervalued or overvalued. Now with NAB, and historically this has been true for me, whenever I see NAB, ANZ or Westpac, P ratio get below probably 12, I might get a little bit interested in a trade, particularly if it gets below 10. I've done this a few times in the past 12 years. When one of those 3 major banks' P ratio gets below 10, I will buy some shares, not for the long term, just for a trade. So historically, when the P ratio of these companies get below, say, 12, good value. When the P ratio gets above 15 to 16, not good value. That has been historically true. So where are we when it comes to NAB? So right now it's about 18. It's well above historical ranges. In fact, if you just draw a line, it's only been above 18 once. And that was back in 2021. Even prior to COVID-19, the peak in P ratio of NAB was 15.9. And I would have considered that to be expensive for this company. Now, over the last 10 years, the low in the P ratio was during the COVID-19 financial panic. But other than that, the low has been back in 2016 was 9.9. And we also saw it get to 11.1 in 2023. Those were actually good times to be thinking about buying banks for the short term, maybe even medium term. But right now, it's at 18. Or it's below 18 now because the share price is dropping. So I would not consider NAB to be good value after this 7% drop. And my other concern would be a shift in sentiment that could see the share price of this company drop significantly more from here. So the other one I like to look at is price to book. In fact, I probably do prefer price to book. Now, for the banks, particularly NAB, Westpac and ANZ, you notice I'm leaving out CBA. It's a little bit different. I would consider CBA to be a much higher quality company than those other 3. But for those other 3, price to book, I'll probably consider 1. If I saw the price to book of any of those 3 banks getting to 1, I reckon that's pretty good value. So probably 1.2 would be the point where I'd be going, that's not bad. Once I see the price to book getting above 1.6, 1.7, overvalued. So let's have a look at the price to book of NAB over the last 10 years. And it does trade in a fairly narrow range, typically between about 1.3 and about 1.7. And right now it's at 1.9, about 2 after the drop today. No, 2, but now 1.9 after the drop today. And that is really historically high, particularly over the last 10 years. We have not seen the price to book of NAB this high before in the last 10 years. Maybe before that it was. And that's another reason, another argument that even with this drop, NAB is not good value at these levels because of a unusually high price to book, unusually high price to earnings as well. So I need to see the share price drop probably about 30 to 40% before I even become interested in buying or taking a trading position in this company. Okay, and I suppose we should finish off with the chart. NAB chart. Has it turned nasty? That's the one thing I'm looking for here. Has it turned nasty? Interesting enough, I did have this dashed line, which was a very important level for NAB, because we have seen the share price hit this level twice in the past, say, 6 months. And right now, it's on that level, $36.50. So if the share price drops below this and stays below for maybe 3 or 4 days, that would be a negative move. But this chart has the potential to go negative. Now, on the flip side, if you don't care about valuations at all, this could be a buy the dip because it is at support level right now. So interesting enough, even though I would say it's not undervalued, I'd still say it's overvalued. Just by looking at the chart, I actually see a trade here on the anticipation you might see the share price jump or rebound because the share price has dropped. And obviously, there's people out there thinking there's good value at these levels. So there is that potential, but I wouldn't see much upside, even if you do get a bounce. I would say maximum 4%, 5%, which for me, with the potential risk of it dropping quite significantly from here, it's just not worth it. Anyway, so that's all I have for NAB. Is NAB undervalued at these levels? I'd say probably not. Well, I'd say actually definitely not. But the chart shows me that there could be a bounce. All right, that's all I have for this video. If you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.